Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about my stock pick, my top stock pick for October 2021, and we'll go through the portfolio as well. But if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So we'll go through what the portfolio closed out at today. The portfolio closed out at $7,121.23. down $141.02, down 1.94%. For the week, we are up $13.15, up 0.19%. And for the month, we are down $162.11, down 2.23%. For the 3 months, we are up $80.64, up 1.15%. For the 1 year, we are up $1,009.77, up 16.52%. And for the all, we're up $1,014.96, up 16.62%. And so we are going to go through the stock that we are going to be buying, and you can take a guess, but it is Royal Bank of Canada, ticker symbol RY, closing out today at $126.57, down 1.39% on the day, down 1.09%. This is a stock you can buy fractional shares in, as you can see with the symbol on the screen there of the pie. And so the position that we currently have has 9 shares, total position value of $1,139.13. Our average price getting in is $114.74, and it holds about 16.35% of the portfolio. Today's return was down $12.51. down 1.09%, and our total return since owning the position is $106.49, up 10.31%. Now, the reason I'm picking this stock, I'll give you a few reasons, and then we're going to go through a few things that are relevant to what the banks are doing in Canada and why I'm picking RBC, or ticker symbol RY. RBC is short for Royal Bank of Canada, for those that are not in Canada. Okay, so the market cap on this one, which is actually the largest market cap between the big 5 banks in Canada, is $182.26 billion. We have a PE ratio of 12.04. And for those that don't know what a PE ratio, it stands for price to earnings. And the price to earnings ratio will help you determine whether a stock is overvalued or undervalued. Company. A 52-week high came in at $134.23, and our 52-week low sits at $90.75. This is traded on the TSX, so the Toronto Stock Exchange, and the yield, the dividend yield as of today is 3.38%. Okay, we're going to talk about the yield because it might seem low, and it's been getting lower and lower as time has been going on, and the price of the stock was up quite high for the past year. You know, it was up to that 134 mark. We're getting down to that 126. Today was a bloodbath in the stock market in general. Everything kind of just like went down a little bit, which is fine. We need this. It's healthy for the marketplace. But the reason I'm picking RBC is it is the largest based on market cap, cash on hand. All the banks right now have a lot of cash on hand. The reason that they have so much cash on hand, to give you an idea, Royal Bank right now has about $528 billion cash on hand, and that's like liquidity. The reason that these banks have so much cash on hand as of right now is because of OSFI, or OSFI, however you want to say it. It's an acronym for the Office of Superintendent of Financial Institutions. What that is, and I'll show you the definition here. Well, not the definition, but what OSFI is. You can look it up on Google. But to give you the simple layman terms of what they are, is a regulatory body that looks over any kind of financial institute, insurance, mortgage companies in Canada, and they work with the federal government. And so in 2020, when everything happened, OSFI put out a rule, not a rule, but just a temporary pause on any financial institute to increase their dividends, to do share buybacks. And if you don't know what share buybacks are, it's when a company will buy back their outstanding shares from the public or from other institutes. And right now, the outstanding shares for Royal Bank of Canada is about 1.42 or like $1 trillion. Yeah, no, 1.42 billion. Sorry, $1.42 billion worth of outstanding shares as of 2021 July, end of July, when they reported their last quarter, not this most recent one. But what does that mean for Royal Bank of Canada? What does that mean for all the big five banks of Canada? And if you don't know what the other big five banks are, that's TD, Royal Bank of Canada, of course, Bank of Montreal, CIBC, and Bank of Nova Scotia. Those are the big five. And I have 4 of the 5 in this portfolio. So right now, with that rule, they haven't increased their dividends for almost a year. Yeah, it's been over a year that they haven't done that. And they haven't done any share buybacks for the year, for the past year and a bit. And they haven't done any acquisitions. What a hard word that is. And so what does that mean? All this profit that they're making, and to give you an idea of what their profit margins are, Royal Bank of Canada's profit margin sits at about 27%, I think it is. Yeah, 27.06%. So for everything that they may sell, because they are a company, they do sell things. Banks are not just these things that hold your money. They are a business. Their profit margin sits about 27.06%. The average profit margin for a lot of companies, anything above 15% is great for a company. Okay. So they've been accumulating all this cash and it hasn't been going anywhere. And it just keeps piling up. They can't pay it out to shareholders. They can pay out their existing dividends, but they can't increase their dividends. They maybe want to expand. Now, these are massive companies. They can't expand as big percentages as they used to when they were tinier. And so the acquisitions are not happening and they can't do share buybacks. Share buybacks are really good. I talk about this in a lot of the videos that I do, and how it's really, if they're not doing it, it can be a silent killer, or if they're issuing more shares out to people, it could mean that they're running out of cash. But Royal Bank of Canada, any of the banks don't have troubles with that. They are very liquid, and that is thanks to the regulatory body of OSFI making sure that these companies, these institutes, can survive during any financial stress in the economy, in the market. They are kind of there to be the guardrails if anything were to happen, to make sure that these companies are solvent. And so these companies are more than solvent now. I mean, and this is why I'm going heavy in the bank side, bank sector, the financial sector, is because they're eventually going to have to get rid of that rule where they cannot increase dividends and do acquisitions, or do any share buybacks. And they're gonna, because usually banks or financial institutes will pay out anywhere from 40 to 50% as a payout ratio to their shareholders, which is fantastic. But right now, they just can't do that because of this rule, because of the regulatory bodies saying, no, we're just gonna hold off because we don't know what is gonna happen in the near future. Now in the US, they have lifted that ban, and I'm pretty sure we will follow suit eventually. And what does that mean for us? Us shareholders in the banking sector, it means we could see anywhere from a 13% dividend increase. And where do I get that 13%? Is because usually institutes will increase their dividends per year, especially Banks of Canada. And it's been a while. Usually they do it maybe every second quarter and increase it just a little bit. But usually on an annual basis, you can see like single digit increases, not just low single digits. I'm talking medium to high single digit increases in the dividend itself. And so what does that look like? I'm talking maybe we can see a 7, 8, 9, maybe even a 10% dividend increase in any of the financial institutes. Pretty much. Okay. So that is why I'm buying Royal Bank of Canada. They are the largest by market cap. TD would be coming in second, and then, which is Toronto Dominion Bank. But the assets they have are absolutely outstanding. We are sitting at assets of over 1.3 trillion dollars in assets. And that's phenomenal. Okay. Now, when you buy a stock in a company, you get ownership of those assets, a small portion of it. And so it's just it's just a no-brainer in my opinion that Royal Bank of Canada or any of the big five, we should all be, now this is not financial advice, but we should all be going heavy. I know I am going heavy into these sectors because I know that my return on investment when it comes to the dividend is going to be substantial and it's going to increase eventually. We have to see that, and I see that because it's typically bank policy that they pay out 40 to 50% of their profits back to shareholders, and it's slowly getting lower and lower because we're having huge amounts of growth. Okay, to give you a few interesting statistics of these big five banks is they hold 84% of the market share in Canada. 84%. That's massive, okay? And they contribute a lot to our GDP in Canada, which is about 3.5% of the country's GDP. And it's to give you numbers, why is that $65 billion in GDP for the country alone? And that is why I strongly believe in the Canadian banks. And it's not like they're the only business, but Canada's banks hold a very strong, reputable business model around the world. They are one of the strongest in the world when it comes to high standards, profits, and so on and so forth. Maybe not profits, but based on, rules and regulations, they have a very high standard and a very safe and secure. Like, it's crazy. And so Royal Bank of Canada is my top pick for October 2021, and we will probably be buying that on Friday when we buy stocks for this portfolio. Other than that, guys, don't forget to subscribe if you enjoyed this video, like and share with those that you love. It's completely optional, but it's completely free. And hopefully you guys have a great week, and we'll see you in the next one. Bye.